If you had invested $10,000 into NVIDIA 10 years ago, you wouldn't just have a nice return, you'd be sitting on more than $400,000 today, turning a modest stake into life-changing money. That's a compound annual growth rate of over 70%. Compare that with the S&P 500's long-term CAGR of just 7 to 10%, and you start to see why this metric, CAGR, is one of the most powerful ways investors judge performance. But here's the tricky part. What's considered a good CAGR? And how do you know when high growth is worth the risks that come with it? To answer that, we first need to understand what CAGR really measures and why it can sometimes be misleading. CAGR, or Compound Annual Growth Rate, answers one simple question. If your investment grew at the same steady rate every year, what would that rate be? It smooths out the wild swings of the market. For example, say you invested $10,000, and 3 years later it grew to $13,310. Your CAGR would be exactly 10%. It doesn't matter if year one was up 30% and year two was down 15%. CAGR turns it into a neat average annual growth rate. What this number doesn't reveal is, while CAGR makes performance look simple, real-world markets never move in a straight line. And that's why knowing what's good depends on context, something we'll uncover next. When it comes to stocks, the S&P 500 has been the gold standard. Historically, it's delivered around 7% to 10% CAGR after inflation. That's the baseline most professionals use when judging an investment. Anything in that range is considered strong, steady, and sustainable. But what about when companies blow past that benchmark? Take Tesla at nearly 36% CAGR over the past decade, or Microsoft at 25%, or Apple at nearly 22%. These are extraordinary numbers, signaling innovation, scale, and market leadership. The risk? They rarely come without volatility. You might have doubled your money with Tesla, but you'd also have had to stomach 50% drawdowns along the way. So while 7% to 10% is historically good, above 10% suggests outperformance. The question then becomes, can it last? That's where business context comes in. Not all growth is equal. For a startup in software or biotech, 20% to 50% CAGR in revenue might be expected in the early years. Tesla's revenue grew at nearly 40% annually over the past decade, and investors rewarded that growth with higher valuations. But once a company matures, the rules change. Coca-Cola or Johnson & Johnson won't post 30% growth anymore. Instead, a 5% to 10% CAGR in revenue is considered excellent because it's steady, predictable, and less risky. The larger the company, the harder it is to sustain high percentage growth. And this isn't just about size, it's also about sector, which leads us to our next point. Every industry has its own growth speed limit. In high-growth tech, SaaS companies can push 20% to 30% CAGR thanks to recurring revenue and global scalability. In consumer goods, 5% to 10% is often the ceiling. Utilities? Typically 3% to 7%, because they're regulated and capital-intensive. Healthcare is trickier. Biotech startups can explode with triple-digit CAGR after FDA approvals, while established pharma companies grind steadily at 5% to 10%. So when analysts say a good CAGR, they don't mean the same number across all industries. They mean a rate that is above average for that specific sector. And that brings us to an important limitation of CAGR itself. Here's the problem. CAGR smooths out volatility, which can hide risk. Two investments might both have a 10% CAGR. One could have delivered a steady climb upward. The other might have been a roller coaster with gut-wrenching losses and huge recoveries. Same CAGR, very different investor experiences. That's why professionals never look at CAGR in isolation. They combine it with other metrics. Standard deviation for volatility, maximum drawdown for worst-case losses, alpha and beta to measure performance against the market. Without those, CAGR can make a risky investment look deceptively smooth. And this leads to the real question. How should you actually use CAGR? CAGR works best as part of a toolkit. Use it to compare long-term performance across investments. Use it to benchmark against market indices, or use it in business planning, projecting revenue or asset growth. But always ask, does this CAGR come with stability, or does it hide volatility? Are the returns in line with historical benchmarks or inflated by unusual cycles? Think of it this way. CAGR is like the speedometer on your car. It tells you how fast you're going on average, but it doesn't tell you about the sharp turns, the potholes, or the traffic ahead. For that, you need the rest of the dashboard. So what is a good CAGR? For long-term investors, 7% to 10% is the historical sweet spot. Steady, compounding, and aligned with decades of S&P 500 performance. Above 10% can be excellent, but usually comes with higher risks. For businesses, the definition depends on stage and sector. 20% to 30% might be normal for a startup, but extraordinary for a global consumer giant. In the end, CAGR is a powerful tool, but only when placed in context. It's a snapshot, not the full story. And for investors who understand that, it can be the difference between chasing flashy numbers and building real, sustainable wealth.